Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Darden Restaurants, Inc. quarterly report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand or sustain the business. Darden Restaurants, Inc. offers a diverse range of dining experiences through its various brands. At the forefront are Olive Garden and Longhorn Steakhouse, two well-established full-service restaurants with a strong presence in the United States and Canada. In addition to these iconic brands, Darden also operates Cheddar's Scratch Kitchen, which serves up classic American comfort food, and Chai's, a Tex-Mex favorite. The company's portfolio also includes Yard House, a popular destination for beer enthusiasts and those seeking upscale casual dining. Fine dining is represented by Ruth's Chris Steakhouse, the Capitol Grill, and Eddie vs. Prime Seafood, each offering an exceptional culinary experience. For those looking for something more laid-back, Seasons 52 provides a fresh twist on seasonal cuisine in a warm and inviting atmosphere. Rounding out the list are Bahama Breeze, which transports customers to the Caribbean with its tropical flavors, and the Capitol Burger, a gourmet burger joint. Darden Restaurants also operates under its own brand name, offering a range of dining options for every taste and preference. The stock price of Darden Restaurants, Inc. has remained relatively stable over the past year, with no significant changes. However, pinpointing specific news events responsible for this stability is a challenging task due to the nature of available search results. News aggregators and search engines typically highlight events that cause notable stock movements or provide general company updates. As a result, identifying specific news events that did not result in a significant stock price change requires an exhaustive analysis of all news related to Darden Restaurants, Inc. over the specified period. This level of detailed financial analysis is beyond the scope of a direct search query. Consequently, it is not feasible to generate a list of events that explicitly caused no significant change based on readily available search results. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the acquisition of Chai's Holdings in October 2024 was a significant contributor to revenue expansion. Additionally, the sale of Olive Garden Canada locations in July 2025 also had a positive impact on revenue. Furthermore, an increase in sales across all segments and higher average check and guest counts were other notable drivers of growth. On the decline side, several factors contributed to a decrease in revenue. A significant driver was the decrease in food and beverage sales, which negatively impacted overall revenue. Moreover, an increase in restaurant labor expenses also had a negative impact on revenue. The Longhorn Steakhouse segment experienced a decline due to higher food and beverage costs and restaurant labor costs, while the fine dining segment faced similar challenges. The net income of the company experienced a significant increase over the past 2 fiscal years. In Q2 FY26, it rose by 10% from $215.7 million to $237.4 million compared to Q2 FY25. Furthermore, the first 6 months of FY26 saw an even more substantial increase of 17%, reaching $495.3 million. The improvement in net income can be attributed to various factors. Firstly, the company's operating income margin increased by 0.8 percentage points from 9.9% in the first 6 months of FY24 to 10.7% in the same period of FY26. This indicates a more efficient use of resources and better cost management. The increase in operating income can be attributed to several key factors. The company's pricing leverage and cost-saving initiatives have contributed significantly to its improved financial performance. Additionally, a decrease in marketing expenses has helped reduce costs without compromising sales growth. Furthermore, general and administrative expenses have also decreased, allowing the company to allocate more resources towards revenue-generating activities. Overall, the combination of these factors has led to a substantial increase in net income and profit margins over the past 2 fiscal years. The company's ability to manage its costs effectively and maintain pricing power has been instrumental in driving its financial growth. The company's operating cash flow status has been inconsistent across different pages. However, a closer look at the data reveals a more promising trend. On pages 9 and 11, it is clear that the company is generating significant positive operating cash flows in both years. In fact, page 11 shows an impressive $1.23 billion in positive operating cash flow. This suggests that despite some fluctuations, the company has been able to generate substantial positive cash flows from its operations. The company's debt level has experienced a notable increase over the past year. According to the financial reports, total current liabilities rose by 17.4% from $2,247.50 to $2,650.50. Furthermore, as of November 23, 2025, the company's total debt stood at $2.38 billion, and this figure increased to $2.65 billion in 2026. This significant increase in debt level is a notable trend. However, despite the rising debt level, there has been no substantial change in interest expenses. The reports indicate that interest net decreased by 0.1% for the 3 months ended November 23, 2025, and interest expense as a percentage of sales also decreased during the second quarter. This suggests that while the company's debt is increasing, its interest expenses remain relatively stable. Management is optimistic about the company's outlook for fiscal 2026, expecting sales growth between 8.5% and 9.3%. This growth will be driven in part by the opening of 65-70 new restaurants, which will contribute to an increase in same-restaurant sales growth of 3.5%-4.3%. The company is also investing heavily in technology initiatives, which are expected to play a key role in driving future growth. In addition to these operational efforts, management has authorized a new share repurchase program, allowing the company to purchase up to $1 billion of its outstanding common stock. This move suggests that management is confident in the company's ability to generate cash and return value to shareholders. The acquisition of Chai's is also expected to contribute to growth, although results from this transaction will not be included in calculations until Q4 fiscal 2026. Overall, management's strategy for fiscal 2026 appears to focus on a combination of organic growth through new restaurant openings and technology investments, as well as strategic acquisitions. The company's commitment to returning value to shareholders through share repurchases also suggests that management is confident in the company's long-term prospects. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out significant amounts in recent years, with $330.5 million paid out in 2024 and $349 million in 2025. In addition to paying dividends, the company has also been actively buying back shares from its existing shareholders. The amount spent on share buybacks has increased over time, with $314.2 million spent in 2024 and a significant jump to $407.1 million in 2025. This demonstrates the company's commitment to returning value to its shareholders through both dividend payments and share repurchases. Concerns about inventory buildup and supply chain disruption are valid. The potential impacts of shortages, delays, or interruptions in the delivery of food and other products from third-party vendors and suppliers can have far-reaching consequences for businesses. One area of concern is the higher-than-anticipated costs or delays associated with opening, closing, relocating, or remodeling restaurants. These issues may indicate underlying supply chain problems that need to be addressed. That concludes the financial summary for Darden Restaurants, Inc. Feel free to comment below, and I will be happy to answer them when possible.